Good morning, everybody. I would like to welcome you to our Belfint briefing, which is our year-end tax update. You will get to have 3 speakers today from Belfint. Myself, Valerie Middlebrooks. I am a director in the Tax and Small Business Department. We also will be having Mike Kelly, who is a principal, also in Tax and Small Business, and Carly Laughlin, who again is a principal in Tax and Small Business Department. So without further ado, I'm going to turn it over to Mike Kelly, who's going to start with the employee retention credit updates.
Okay, so Val said I'm going to start with the employee retention credit. And before I get to that, let's quickly go over what today's agenda will look like. So a lot of tax law changes since COVID came. For those of you who have attended last year's Belfint briefing, we spent a good amount of the presentation talking about the CARES Act, which was passed around March of 2020. So we're kind of going to cover all the tax law changes since then. Now, usually one good tax law change per year is enough for us to handle. But as you can see in our agenda, there's been a lot of tax law changes since March of 2020. It's about a year and a half, and there's been about four decent sized bills that have impacted us in some way. So it's been certainly a tough time for probably most CPAs, across the states. So let's talk about each of these items very briefly, at least the timing of things. And this agenda is not necessarily in chronological order, but it's just how we're going to talk about stuff. So the employee retention credit, that item came out of the CARES Act. We certainly talked about it at last year's Belfint briefing. This is going to be a mini version of that. We're going to talk about it because there have been some changes to it since the last time we spoke, some clarification. And you know what? It's a very powerful credit that all business clients should be taking advantage of. So if you are not aware whether your CPA at Belfint or someone else you have not looked into that yet, please reach out to them. They should be familiar with it. So then what happened after the CARES Act? After the CARES Act, the Consolidated Appropriations Act, which is at the bottom of this agenda, was passed at the end of 2020. And then a few months later, in early 2021, the American Rescue Plan Act was passed. And then rather recently, the Infrastructure Investment and Jobs Act was signed into law by President Biden. And then the item that you probably heard in the news the most is about the Build Back Better bill, which has recently passed the House and is sitting with the Senate. And if we're lucky, I'm not sure if we're going to be lucky if it gets passed, it'll be more tax law changes. But if we're lucky, it will be passed. It would go through by right around Christmas time. So that's your timeline of all the bills getting passed. All right, so let's get started with the employee retention credit. So on the screen represents all the claims I put in for my clients for the employee retention credit. And I put it here just to kind of show the magnitude of this credit. It's over $1 million of claims. I'm just one person at our firm. I'm sure a lot of other directors have put in big amounts too. But this is like, in my mind, kind of like a once in a lifetime opportunity to take advantage of, where there's a lot of refunds that can be claimed for this credit. So I thought this was just a good slide to really emphasize all the claims put in. And, I can probably say I got about half of them back thus far, or a little bit less than half of that at this moment. Okay, so let's do a refresher on how the employee retention credit is calculated. It is a credit based on wages paid to your employees. So as long as you qualify for the employee retention credit, as long as you have to qualify for it, it is a credit based on wages paid to employees. Now, there's different rules for 2020 and 2021. For 2020, the credit is a 50% credit based on up to $10,000 of wages per employee. So that's for wages paid after March 12th, 2020. It also includes health insurance paid on behalf of your employees. That item is sometimes missed, so keep that in mind. Health insurance and wages. In 2021, the percentage credit increases from 50% to 70%, so it becomes much more generous, and it's also measured on a quarter by quarter basis. And those quarters are quarter one, quarter two, quarter three of 2021. That does not include fourth quarter 2021. Recent legislation has eliminated Q4 from claiming the employee retention credit in most cases. So let's look at a quick example here of how 2020 compares to 2021. So again, assuming I'm eligible for the employee retention credit, I pay employee A $8,000 in 2020. Then I get a credit of 50% of wages paid to him, $4,000. Employee B, I pay him $10,000, 50% of that is $5,000. Employee C, I pay them $12,000. The credit is only $5,000. The credit is only $5,000 because my wage base on which I can take the credit is limited to $10,000. So 10,000 times 50% is $5,000. What about 2021? Let's look at the example there. So remember, this is a quarter by quarter analysis, which is nice because you can really get more bang for your buck. And you also get 70% of wages paid. So employee A, I pay them $5,000 per quarter. I get a credit of 70% of that amount per quarter. So it's $3,500 per quarter, up to $10,500 for the 3 quarters combined. Employee B, $10,000 a piece. I pay him $10,000 of wages each quarter. 70% of $10,000 is a $7,000 credit per quarter. And employee C, $20,000 per quarter. Again, I am limited to the maximum wage base of $10,000. So I am limited to 70% of $10,000, $7,000 per quarter. So employee B and C are in the same shoes, even though I pay employee C more wages. But $21,000 is nothing to sneeze about for just one employee. Okay, so who is an eligible employer? So we talked about how much the credit is. Let's talk about whether you're eligible for it or not. So you can't just pay wages in most cases to your employees and hope to be eligible for the credit. One of 2 things have to happen. The first one would be a full or partial shutdown by the government that does not allow you to operate due to COVID-19. So think of your restaurants where the government comes in and just doesn't let you open up doors to customers because they're worried about the spread of COVID. So that's the first one. The second one is more of a bright line test, and that is a significant drop in gross receipts. So if you have a significant drop in gross receipts, you would also qualify for the employee retention credit for that particular quarter. And we'll talk more about that. Okay, so let's talk about the significant drop in gross receipts first. And before we talk about a significant drop in gross receipts, we need to know what is gross receipts. And gross receipts are, well, we can talk about the technical language, is Section 448C, but we don't want to get too much in that. I think the easy answer is pretty much everything, right? Everything that, all your receipts for the year are essentially your gross receipts. The one thing that the IRS has made clear is your gross receipts do not include PPP forgiveness. which is good, because Section 448C says that tax exempt income is included in gross receipts. And if you've been following all this PPP stuff, you know that it's tax exempt. It's not taxable. And normally Section 448C probably would capture that, but the IRS gave us a break on that and said gross receipts don't include that. That's a good thing, because we are looking for a drop in gross receipts from, and we'll talk more about that, but we are looking for a drop in gross receipts. And if we have PP funds in our gross receipts, well, our receipts are high, and that's not what we want if we want to be eligible for the employer retention credit. Okay, so what is a significant drop in gross receipts? We have different rules for 2020 and 2021, and let's start with 2020. So for 2020, if I look at a quarter for 2020, I compare it to the same quarter in 2019. If my gross receipts drop by 50% or more, then I am eligible for the employee retention credit during that quarter. All right, so that's for all wages paid during that quarter. There, I'm eligible, except for quarter two, which begins on March 12th, is when you start becoming eligible in 2020. Okay, so 50% drop in gross receipts, that's kind of tough to get, even though it certainly can happen, but it's not necessarily a good thing if that happens, because your business is in serious trouble. 2021, they relaxed the rules further for this, so you have a much bigger opportunity to maybe get this in 2021, because all they require is a 20% drop in gross receipts. 80% is highlighted on your screen, but it's just getting worded differently. But the main thing you need to know is if you have a 20% drop in gross receipts, when I take a quarter in 2021 and I compare that same quarter to 2019, then I could be eligible for the employee retention credit. The one nice thing about this item is if I have a recovery in the following quarter, meaning I get above, I get above this 50% threshold or above this 20% threshold, I have a recovery, I start bringing in more receipts, then I am still going to be eligible in that quarter if I was eligible in the previous quarter. So just by strictly being eligible in quarter one of 1 year, I will automatically be eligible in quarter two underneath the wording of how these rules work. Does a significant decline in gross receipts have to be COVID related? And the answer is no. So that could be an opportunity for clients that really maybe they didn't even suffer from COVID-19. So again, our measuring point, our base period is 2019. Let's just say that we had a great year in 2019. We had a banner year, one of the best years we could have. But that was just a blip in the radar. We usually don't have years like that. But in 2021, we're back to normal operations. If our revenue dropped 20% from 2019, it doesn't matter if it was related to COVID or just because we had a great year in 2019 and things are back to normal now, you still qualify for the employee retention credit. So we talked about there's two ways to be eligible for the employee retention credit. The first one we just discussed was having a significant drop in gross receipts. The other one is if you are partially or fully shut down by a government to help contain COVID-19. And I like this example right out of an IRS notice. It's as close as you're going to get to some sort of bright line test when it comes to something that's not really so objective. So let's just look at this example, which explains what a partial shutdown is and whether a partial shutdown would, this type of partial shutdown would be eligible to count for the employee retention credit. So the example is just a restaurant, and before COVID comes, the restaurant provides some dine-in services and some takeout services. And in scenario one, COVID-19 comes and the government tells the restaurant, no more dine-in, no more dine-in. We'll let you keep doing the takeout, but we don't want customers in your establishment. That is considered a partial shutdown. In scenario two, the government comes in, again, they say no more dine-in, but if you have some outdoor seating, we'll let you do the outdoor seating, we'll let you continue to do the takeout. That is still considered a partial shutdown. In scenario three, the government comes in, they say, okay, we'll let you do takeout, we'll let you do the outdoor dining, and we'll even let you do a little bit of indoor dining, but you really have to space those tables out. You got to get them more than 6 feet apart. And if the restaurant was accustomed to having those tables much, much closer, then that could be argued that is a partial shutdown. I had clients, I have eye doctor clients who were restricted to only doing mandatory surgeries, not any type of elective procedures for a period of time when COVID first came. And we took the position that that was a partial shutdown during that period of time. Now, the one big difference between shutdowns versus significant drop in gross receipts. If I have a significant drop in gross receipts, then all wages paid during that quarter are eligible for the employee retention credit, except for that first weird one in 2020, starting, I think, around March 12th was the date. But in general, if you have a significant drop in gross receipts from quarter to quarter, then all wages eligible. If you have a partial shutdown or full shutdown, then only wages paid during the period of shutdown count for the employee retention credit. All right. Okay, so let's say you qualify for the employee retention credit. You had a significant drop in gross receipts. You had a full or partial shutdown, one of the two. Biggest hurdle to actually getting that credit after that is your employee count. And if you had more than 100 employees during 2019, and it's an FTE count, but if you had more than 100 employees during 2019, then it makes it very hard to claim the credit in 2020. So the employee count is based on 2019, but we're talking about the 2020 credit right now. So what happens is if you had more than 100 employees, the only way you get employee retention credit is if you paid your employees to essentially stay at home and do nothing. They cannot be providing services to you if you intend, and if they do provide services, you're just not eligible to take the credit for that. So basically, I think Congress they wanted their big employers to really take care of their employees that were suffering from COVID. The 100 employee count goes up to 500 employees in 2021. So again, we are looking at the 2019 employee count, but that 100 employee threshold increases to 500. So it's a lot more easier to get this credit if you have a lot of employees in 2021 compared to 2020. Okay, what happens if you hire mom, dad, daughter, son in the business, any of those related parties? They are not, and if I'm more than a 50% owner of the business, so it's for those that are more than 50% owners in the business. If I hire family, my family or close relatives, they are not eligible for the employee retention credit. There's also been some confusion out there on whether the 50% owner is eligible for the employee retention credit. The code is written in a crazy, funny way here, but it's certainly my position that owners are not eligible for the employee retention credit. You claim the credit on Form 941, and we typically just file amended return. Those 941s are your quarterly payroll tax forms. So we wait until the end of the quarter to kind of get a good idea about the significant drop in gross receipts, and gives us additional time to calculate what the credit is, and then we eventually amend the 941 to claim it. It's taking the IRS at least 6 months to process these returns. So it is a bit of a delay, but the IRS has been somewhat consistent in doing these returns in some sort of FIFO order, first in, first out. The PPP is starting to go into the rearview mirror for most of us. If you've got PPP number 2, this slide will be important to you as you apply for forgiveness for that. But you cannot claim the employee retention credit on the same wages that are used on the PPP forgiveness application. So we all know PPP forgiveness application, you need payroll expenses to qualify for forgiveness. A portion of those costs have to be payroll expenses. So you just can't use the same wages. There are ways for us to optimize the PPP forgiveness and the employee retention credit. I won't get into the weeds there, but keep that in mind that you want to maximize both, and there's certainly ways to do it. The one big item I believe that came out of the American Rescue Act is the concept of a recovery startup business. And a recovery startup business is any business that began operations on February 15th, 2020, after February 15th, 2020. And your gross receipts can't be more than $1 million, essentially. I mean, it's an average gross receipt number, but essentially think of it as, less than $1 million. And most of your startup businesses aren't going to be making $1 million right off the bat. So this is an opportunity if you start a business after February 15th, 2020, or any time after February 15th, 2020, you can be eligible for the employee retention credit in Q3, Q4 of 2021 without having to show a drop in gross receipts, without having a full or partial shutdown. You're going to automatically be eligible in Q3, Q4 2021, and you can essentially claim a credit up to $50,000 per employee. Not per employee, $50,000 per quarter, $50,000 per quarter. And the credit is calculated in the same way we've been talking about this whole time, 70% of wages paid for 2021. Taxability, if you receive an employee retention credit, and if the credit is from wages paid in 2020, then you lose the deduction for those wages in 2020. If the credit is based on 2021 wages, then you lose the deduction for those wages in 2021. Those wages are essentially reduced by the amount of credit that you claim. So this is the one drawback of it, of course. We hate to pay taxes on these credits, but you have to do it. And you even have to do it if it takes the IRS 6 months to provide you the refund. So if you get a credit for, $50,000, that's essentially $50,000 of taxable income right now at this moment. Well, actually, when you file your tax return, I should say, and you may have to pay. You may have to pay tax on it now, but then you may not get the refund for another 6 months. Okay, that concludes the employee retention credit part. I'm going to turn things over to Val now, who is going to talk about the American Rescue Plan.
Thank you, Mike, and happy to be back. So I am going to talk about the American Rescue Plan, which was signed by President Biden on March 11th, 2021. I don't know about you guys, but that seems kind of like a lifetime to ago to me. So I had to refresh my memory on what was actually in this bill. So we're going to start off with the extension of the limitation on excess losses for non-corporate taxpayers. So this was a provision that actually started in TCJA a few years ago. This was the one that limited the trader business individual losses to, it started out at $500,000 and it has been indexed for inflation. This was one of those provisions from TCJA that was going to set to expire on January 1st, 2026. So the American Rescue Plan actually extends that date to January 1st, 2027, so an additional year. But stay tuned, because once we move to Carly to talk about the Build Back Better bill, there is some more provisions contained in that bill that may also make this provision permanent, or at least that's what they're proposing. Okay, the next item I want to talk about was the suspension of tax on a portion of unemployment compensation. So this provided early-ish in 2021 an exclusion. So prior to this exclusion, an individual's gross income did include all unemployment compensation, at least for federal purposes, as taxable income. So for tax years beginning in 2020, so this was a 2020 only provision, if the adjusted gross income of the taxpayer for the tax year is less than $150,000, the gross income of the taxpayer does not need to include unemployment compensation up to $10,200. There was no phase-in for this AGI limit. Bright line test 150,000 AGI, and that limit applies to all types of taxpayers: joint, head of household, single. However, in the case of joint taxpayers, they are allowed to take the $10,200 exclusion each separately. So each spouse would be able to exclude that maximum amount. Also, when determining your AGI for this purpose, you do not include the unemployment compensation you've received. So some taxpayers obviously had already filed their returns prior to March 11th, and the IRS provided guidance that those taxpayers should not go ahead and amend their returns, that they were going to use their systems to identify taxpayers who had paid tax on these funds and issue refunds. So as of a couple weeks ago, when we had to sort of finalize this slide deck, I did find on the IRS website that so far they have issued 11.7 million refunds, totaling approximately $14.4 billion. And the reason I'm mentioning this provision is that I think it's probably a good idea to follow up with taxpayers this year when we're doing their 2021 return, if we had one of those taxpayers, to see if they indeed got their refund, or if maybe they need to follow up with the IRS on that. The 2021 recovery rebate for individuals. So under the American Rescue Plan Act, an eligible individual is allowed an income tax credit for 2021 equal to the sum of $1,400 per individual taxpayer, $2,800 for joint returns, and $1,400 for each dependent of the taxpayer. And this credit is non-refundable and includes qualifying children as well as qualifying relatives. Estates and trusts aren't eligible for the credit. Similar to last year, so we had this credit last year, and this obviously is tied into the economic stimulus payments. There are phase outs. So the phase outs for 2021, which I believe are the same as they were for 2020, are $150,000 for joint filers, fully phased out at $160,000, $112,500 for head of household, fully phased out by $120,000, and $75,000 for all other taxpayers, fully phased out at $180,000. So again, we'll be reconciling these amounts on the 2021 tax returns for our clients. Okay, child tax credit improvements. So before the American Rescue Plan Act, the child tax credit was $2,000 per qualifying child. And a qualifying child was defined as a child under the age of 17, so up through age 16. The $2,000 child tax credit was phased out for taxpayers with modified adjusted gross income over $400,000 for joint taxpayers and $200,000 for all other filers. The child tax credit was partially refundable to the extent of 15% of a taxpayer's earned income exceeding $2,500. Under the American Rescue Plan Act for 2021, they made some enhancements to the credit. So the first is the definition of a qualifying child has been broadened to include a child who hasn't turned 18 by the end of 2021. So for 2021 only, 17-year-olds will now qualify for the child tax credit. They also increased the child tax credit to $3,000 per child or $3,600 per child if the child is under the age of 6 at the close of the tax year. But these increased credit amounts are phased out at modified AGI of $75,000 for singles and $112,500 head of household and $150,000 for joint filers. This phase out is limited so that it only applies to the temporarily increased amounts for 2021. It does not apply to the original $2,000 of child tax credit that's permitted under existing law. After applying these phase outs to the increased credit, the taxpayer's $2,000 child tax credit will then be subject to the phase out rules that were existing prior. So for 2021, the child tax credit is actually subject to 2 sets of phase-out rules. Taxpayers who aren't eligible to claim the increased credits for 2021 because their AGI exceeds these limits are able to claim the child tax credits under the old laws and the old phase-out rules. Also, the child tax credit is fully refundable for 2021. As long as the taxpayer's principal place of abode is in the United States for more than 1/2 of the tax year, or for a taxpayer who is a bona fide resident of Puerto Rico for the tax year. The $500 partial child tax credit for dependents other than qualifying children remains non-refundable. The IRS also issued temporary advance payments on these child tax credits in 2021, equal to 50% of the IRS's estimate of your eligible tax credit. And they were making payments on these for the 6-month period, July 2021 through December 2021. Taxpayers who received these advanced child tax credit payments from the IRS in excess of the actual child tax credit allowed as calculated on their 2021 return will generally have to repay these excess amounts by recording an additional tax liability on their 2021 return. Okay, the next area is the earned income tax credit. And again, this bill provides a number of enhancements to those provisions. Now, some of these changes relate to 2021 only, and some of them relate to or start in 2021 and will continue at least until the rules are changed again. And I'll try to distinguish between each type as I go through the enhancements. So first, in determining your earned income tax credit for 2021 only, taxpayers may elect to substitute their earned income from 2019 for their earned income in 2021 if it is beneficial for them to do so. So if that results in a higher tax credit, they are able to do that. They also eliminated, again, for 2021 only, the maximum age for the earned income credit. So anybody at, who's over the minimum age, which I think is 19 now under this bill, is eligible to claim the earned income tax credit. They also increase substantially the disqualified income threshold So if you have too much disqualified income, which is generally investment type income, interest, dividends, capital gains, you would be excluded from taking the credit. So the threshold was $3,650. It's been increased to $10,000 for 2021. This is a provision that will go beyond 2021, so it will also be indexed starting in 2022. So another new provision is that a qualifying child is taken into account for the earned income tax credit, even if the taxpayer does not meet the identification requirements with respect to that qualifying child. So what that provision provides for is, in the past, if a taxpayer had a qualifying child, could not meet the identification requirements, they were excluded from claiming the earned income tax credit at all. They could not claim it as a single taxpayer or as a taxpayer without qualifying children. This bill allows them to claim the earned income tax credit as if they were a taxpayer with no children. So again, allowing eligibility where eligibility had not been before. Also, the earned income tax credit for 2021 only is expanded for those taxpayers with no qualifying children. So the 7.65% credit percentage and phase out range for those taxpayers has been increased to 15.3%. The $4,220 of earned income amount has been increased to $9,820. And the $5,280 phase out amount is increased to $11,600. Also, the $5,000 increase for married taxpayers filing a joint return stays the same. So the phase out range under this provision for those taxpayers would be $16,610. So they also expanded the rules for certain separated married taxpayers who do that, so that they do not need to file jointly. Those rules have been relaxed. So, and this starts in 2021 and will continue. So an individual will not be treated as married if the following apply. Obviously, they're married. The individual does not file a joint tax return for the year. The individual lives with a qualifying child for more than half of the tax year, and either one of these two provisions. During the last 6 months of the year, the individual does not have the same principal place of abode as their spouse, or the individual has a written separation agreement or a decree requiring one spouse to make payments for the support or maintenance of the other spouse. Okay. Dependent care assistance improvements. So before the American Rescue Plan Act, the expenses taken into account in determining the credit couldn't exceed $3,000 for one qualifying individual, and by qualifying individual, I mean a child, or $6,000 for more than one qualifying child. Before the American Rescue Plan Act, the credit was 35% of employment-related expenses for taxpayers whose adjusted gross income for the tax year was $15,000 or less. That 35% was decreased by 1 percentage point for each $2,000 of additional adjusted gross income until it was reduced to 20%. Then the 20% credit applied when AGI reached $43,000 and above. So for tax years in 2021 only, the American Rescue Plan provides for a number of enhancements. So the credit is now refundable for taxpayers with a principal place of abode in the United States for more than 1/2 of the tax year. Also, the dollar limit on the amount taken into account has been increased pretty dramatically. So to $8,000 from $3,000 for one or more qualifying child, or to $16,000 from $6,000 for 2 or more qualifying children. The applicable percentage has also been increased from 35% to 50%. However, this increased percentage is reduced by 1 percentage point for each $2,000 by which the taxpayer's AGI exceeds $125,000. So for taxpayers with adjusted gross income of $25,000 or less, the maximum amount of the credit for 2001 is potentially $4,000 for taxpayers with one qualifying individual, so $8,000 at 50%, or $8,000 for taxpayers with two or more qualifying individuals, which is the $16,000 at 50%. This increased phase out range is also subject to, again, sort of a two-tier phase out. So I'm going to just kind of run through the calculation from the top to the bottom, which I think is helpful. So the applicable percentage is 50% for taxpayers with AGI of 125,000 or below. The applicable percentage then will decrease by 1 percentage point for every $2,000 by which the taxpayer's AGI exceeds $125,000 until your AGI reaches 185. At that point, the applicable percentage is 20,000 for taxpayers with AGI greater than 185,000 and remains at 20% until the taxpayer reaches 400,000. For taxpayers with AGI above 400,000, again, the applicable percentage will decrease by 1 percentage point for every $2,000 until you reach complete phase out of $440,000. So once you reach there, your credit amount is zero. Lastly, they provided for an increase in the exclusion for employer-provided dependent care assistance. So an eligible employee's gross income generally doesn't include amounts paid or incurred by an employer for dependent care assistance provided to that employee under a qualified dependent care assistance program, or DCAP for short. Under the pre-American Rescue Plan law, that amount that could be excluded under this type of provision was maxed out at $5,000. For 2021 only, the exclusion for employer-provided dependent care assistance has been increased from $5,000 to $10,500. Cafeteria plans will need to be amended for this provision. The amendment can be retroactive as long as it's done by the end of the plan year and effective for the end of the plan year. The premium tax credit. So again, a number of enhancements in the premium tax credit. So a refundable premium tax credit has been available prior to this enactment on a sliding scale basis for individuals and families with household incomes between 100% and 400% of the federal poverty line, who are enrolled in an exchange purchased qualified health plan. So the American Rescue Plan makes a couple of changes which broadens the applicability of the premium tax credit. The first relates to the percentage of household income you're required to contribute to your health insurance premiums. So under the Pre-American Rescue Plan Act, a taxpayer might have had to spend as much as 9.83% of household income on health insurance premiums. This provision provides that for 2021 and 2022, under this act, the amount is now capped at 8.5% of household income. So also for tax years beginning in 2021 and 2022, the premium tax credit is now available for taxpayers whose household incomes exceed 400% of the federal poverty line. So these two changes will have the effect of not only increasing the number of people who are eligible for the premium tax credit, but also increasing the amount of the premium tax credit. Also, this was a sort of a late provision in this bill that was provided for a benefit on the 2020 returns. So it included language that said, when taxpayers reconciled the amount of the premium tax credit based on their actual household income, family size, and premiums, if the amount of the advance payments had exceeded what they were allowed to take in the reconciliation on their individual tax return, they didn't actually have to repay those amounts. And that reconciliation occurs on Form 8962. So they got a break in 2020, no such break in 2021, at least in this bill. The last item that they changed or they added was that the premium tax credit was increased for taxpayers receiving unemployment compensation during 2021. So this is a break for 2021. Under the American Rescue Plan Act, it provides special rules for taxpayers who have been approved to receive unemployment compensation for any week beginning during 2021. And this provision provides that those taxpayers can calculate their premium tax credits as if their household income was at the 133% of the federal poverty line, even if it was over that. So the effect of that is it allows them to claim a smaller amount of personal contribution to their health insurance premiums and increase the credit that they're eligible. And this applies to all taxpayers who either received unemployment compensation during 2021 for as little as 1 week. So this is a pretty good provision. Okay, modification of treatment of student loan forgiveness. So prior to enactment of the American Rescue Plan Act, there were some exceptions in the code for cancellation of indebtedness related to discharge of student loans. So generally those are taxable. There were a few exclusions. Those exclusions surrounded things like working for certain institutions in certain areas. So like doctors working in public hospitals in a rural area. They also included death or total and permanent disability of the student, as well as some loans discharged under programs such as the Department of Education's closed schools or the Defense to Repayment Discharge process. The American Rescue Plan Act expands the exclusion from including certain discharges of student loans in gross income. In general, it includes federal, state, or local government entities or an eligible education institution, private education loans, and certain loans made by educational institutions that qualify as a 50% charity. However, one exclusion is that the discharge of a loan made by either an educational institution or a private education lender is not excluded under these rules if the discharge occurs on account of services performed. So if you're working for one of these entities and they discharge some of your debt, that does not count towards these additional exclusions. And these exclusions apply to either a partial or a full discharge of a student loan. Okay, the Infrastructure Investment and Jobs Act. So this was a huge bill, but it only had, a handful of sort of tax-related things. The majority of the bill was all this funding for, obviously, infrastructure investment. So I'm going to cover kind of one large provision and just, go over quickly some of the smaller tax provisions in the bill. So the big tax issue in this bill was the information reporting for brokers and digital assets. So the act would provide that the definition of a broker would now include any person who is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person. This act would provide that the digital asset is now a specified security. So similar to the rules related to stocks and bonds. And these rules are applicable for any security, any digital security acquired on or before January 1st, 2023. So basically a digital asset acquired after that date is now considered a covered security. Brokers would now have to report a customer's basis and gain or loss when a customer sells or exchanges a digital asset. The Act also defines a digital asset as any digital representation of value which is recorded on a cryptographically secured distributed ledger or any similar technology as specified by the IRS. And again, this is for reporting as a covered security. So for securities acquired in 2023, and then reporting, which would actually be required after December 31st. They are also requiring that broker-to-broker transfers of digital assets also are reportable. So if any broker with respect to transfer during a calendar year of a covered security, which is a digital asset, from an account maintained by them, transfers that security to somebody not known to be a broker, they will be required to report that transfer to the IRS. So I'm guessing that we will get some additional guidance on the IRS on how those transactions are supposed to be reported also. The last provision for the digital asset is that they're also now treated as cash for the $10,000 reporting purposes. So under the current code, a person engaged in a trade or business who in the course of that trade or business receives more than $10,000 in cash in one or more related transactions must file an information return with the IRS and furnish the payor with a statement. This act provides that cash does now include digital assets. And again, this will be effective for transactions in 2023 reported after December 2023. Okay, so just a few, so these are sort of what I would call the miscellaneous tax provisions in the infrastructure bill, just so you know what else is in there. It extends several excise taxes used to fund highway spending. It extends and modifies certain Superfund excise taxes. It allows private activity bond treatment for bonds that will be issued for qualified broadband projects and carbon dioxide capture facilities. So again, enhancing the Going Green initiative. It extends pension funding relief, and it expands certain IRS administrative relief for taxpayers affected by federally declared disasters and significant fires. So now I'm going to turn it over to Carly, who's going to talk about the Build Back Better bill.
Thank you very much, Val. So first, I just want to say it's great to see some familiar names attending today, as well as seeing some new names. So thank you so much for joining us. We wish we could all see you in person, but I guess this is the next best method. So I was tasked today to talk about current proposed legislation. And in some ways, that's really fortunate because that's, exciting new topics. But in other ways, it's not so fortunate because everything I talk about today is subject to change. So nothing is set in stone right now, as well as the lawmakers decided to make it kind of cruel joke to make it a tongue twister, the name of the bill, which is the Build Back Better bill. So I'm sure I'm going to stumble on the name today, but that's just the joke that they have given us. So we're going to kick it off. So there are a lot of changes under this bill, and many of them do not actually impact taxes. And we're really going to focus today on the parts that do fall under the tax law changes, because there's a lot of things in this bill. A draft of the Build Back Better bill first came out in September. And originally it was set to be a $3.5 trillion plan. This initial bill contained a lot of items that were going to have some really major tax implications for taxpayers across the board. However, a lot of them did not make it into our current bill as it stands today. So we're going to talk about some of the things. So we're going to start off by talking about the changes that did not make it into the current proposal. That includes higher marginal tax rates on ordinary income for individuals and corporations. So right now, our current top tax rate for individuals, trusts and estates is 37%. And there was some talk about that going to 39%. And that did not make it into the current proposal. There was also talk about higher capital gain tax rates for taxpayers who had income greater than $1 million. That was also a consideration, but that did not make it into the current proposal. There was also in the initial draft talks of eliminating the use of intentionally defective trusts That was a big one. Talk about modifying the Section 199A deduction. That's the deduction that's available for certain trader businesses, up to 20% deduction. They also talked about accelerating the reduction of the unified credit. So right now, everybody gets, $11.7 million lifetime unified credit. And we know for a fact that that's going to be basically cut in half in 2026 based on, if there's no tax at all, no tax changes at all. But they were talking about accelerating that, but that did not make it into the current proposal. And there was also talk about a billionaire mark to market. So you might have heard about some of these things, kicked around in the news, but those items did not make it into the current proposal. I still think it's important to be familiar with what they are, though, because it really is an indicator of the direction that our current legislators are focusing in on, and who says that it won't be necessarily added back in maybe some of the negotiations, but that's just something to keep in mind. Okay, so the Build Back Better bill, the current version, we are going to talk about today, that was passed by the House just last week. So this is very fresh, and it was passed by a vote of 220 to 213. The votes were very closely tied to party lines, and there was only one Democrat that voted against the bill. Republican Minority Leader of the House, Kevin McCarthy, gave an 8-hour and 24-minute speech against the bill, which broke the previous record for the longest floor speech, which was previously set by Nancy Pelosi in 2018, which she talked for 8 hours and 7 minutes. So that's a really long time, but I'm going to try to condense my presentation to be a little bit shorter than theirs today. Despite his lengthy protest, the House did indeed pass this bill, and now it's going on to the Senate, where they'll continue to negotiate it, continue to negotiate some of the components of the bill. The bill is styled as a reconciliation bill, so it only needs the majority vote from the Senate in order to pass. So the Democrats are feeling fairly confident that they can get this through by the end of the year. But I have been reading that there are some Democrats that still have a couple things that they're worried about, and they really need every Democrat to vote for this bill in order to get it through. So I know that there could be some negotiations still happening. Now, it's estimated that the current bill will generate $1.7 trillion of revenue over the next decade. That's before taking into consideration the $658 billion of tax credits for individual businesses, which will have an overall net impact somewhere around $1 trillion in revenue. So these are all I know there's a lot of debate about those numbers, but that's kind of the rough idea. It's also estimated that the bill is going to reduce the long-term GDP by 0.48%, and it's going to eliminate about 125,000 full-time equivalent jobs. And it's also anticipated to reduce taxpayers' after-tax wages take home by about 0.35%. So just giving you an idea of the overall structure. So like I mentioned, we're going to go over some of the key provisions that did make it into the current bill and what you're going to want to know for this upcoming tax season. So family benefits are one of the big pieces of this bill. Now there's, a lot of pushback from the Republicans on this particular topic, so I wouldn't be surprised if we see a little bit of compromising here. But as it stands today, the bill will create a program for paid family and medical leave for employed workers, and that's going to include those who are self-employed for caregiving and personal illness. The program would start officially in January 2024, and the amount of paid leave would be based on income. So it would start at about 90% of income, 90% of income, and it would be phased down for high income earners. Other family benefits included in this bill are free universal preschool for all 3- and 4-year-olds through additional tax credits. There would be a 3-year phase-in of this benefit, which would compare a family's income to their state median's income. And after the 3-year phase-in, then the eligibility would expand to family who had up to 250% of the state median income. And this program is going to initially be funded by government dollars for the first 3 years. And then after that, it's going to be a combination of federal government and state dollars from there on out. Okay. So One of the really big changes that could be coming down the pike for individuals, trust, and estates are the change in the cap on state and local income tax deductions. So if there's any piece that you listen to today, as if you're an individual filer or you're a trustee for a trust, listen to this slide. So if you recall, the Tax Cuts and Jobs Act of 2017, it created a $10,000 cap on state and local tax deductions. That includes your state income taxes that you're paying, that includes your real estate taxes. When you add it all up together, the most you can take as an itemized deduction currently is $10,000. That, along with the increase in the standard deduction, so the standard deduction got a big jump at the same time, a lot less people were itemizing. So we saw a lot of people claiming the standard deduction because of the limitation. However, that might be coming to an end, because as the current proposal stands, the Build Back Better bill is going to increase that $10,000 cap substantially. It's going to increase it to $72,500. Or, if you're in the case of an estate or trust or a married individual filing separate, that number is $36,250. So this would be the most important part about this. This would be effective for the current year, so 2021. So this really means that you want to be paying attention. Now, this may not pass. Like I said, this is all temporary, but you want to keep a very close eye on this because if it does indeed pass, then you might have an opportunity here to prepay some of your state and local income taxes for 2021. Maybe write those estimated tax payments, which are typically due January 15th, maybe accelerate them, write them before December 31st, and accelerate your deduction into the current year. Typically, the rule is accelerating deductions is typically a good thing. So that's something that you want to keep an eye on. It's something that you might want to think about. This, like I said, it hasn't been passed yet, but it is in the current proposal, so it's looking good. And this is something that that if it may or may not get passed before year end, but it's something that you might want to consider doing. There we go. Okay. So the child tax credit. So Valerie mentioned that this was previously restructured in 2021 under the American Rescue Plan, and under the Build Back Better bill, we're going to see further extensions of some of those changes. So the Build Back Better will extend the full refundability of the credit to taxpayers whose principal abode is in the U.S. or they're a bona fide resident of Puerto Rico. It'll also extend the increased eligible age to include children who are under 18, and will also extend the extra bump to $3,600 for eligible children under 6 years old. And of course, this credit still has income limitations associated with it, which are $150,000 married filing joint, or $75,000 if you're a single filer. And then there's currently phase outs as well related to that. Now, if this, I read that if this bill doesn't get passed by, I believe the date was January 15th, I was reading, then they said that it's going to impact the periodic advance payments that they're currently sending out. And so if people are used to getting those payments and this bill doesn't go through with the extensions, then those could potentially be stopped. Such as something to consider. Let's get through. A lot of this is similar, like I said, extensions to what Valerie already talked about. Also, the earned income tax credit will also see some extensions by continuing to lower the qualifying age for those without children from 25 to age 19. But of course, there's exceptions if they're a full-time student. It also eliminates the upper age for this credit for childless taxpayers. Currently, the upper age is 65, but it's going to get rid of that. Federal Pell Grants. Those are awarded to undergraduate students who display a certain degree of financial need. And typically, when you receive those are not taxed if they're used for qualified tuition and expenses. But this bill is going to expand that allowance and basically include things such as room and board if you use your grant for that as not taxable. It's also going to allow those recipients to claim the, claim either the American Opportunity Credit or the Lifetime Learning Credit. Previously, as it currently stands, you can't double dip and have the exclusion and claim those credits, but under the current proposed structure, it will allow you to do both. Okay, so this is another one for individual taxpayers that could be a heavy hit. So, currently we have the net investment income tax. So as a quick reminder, this is the additional 3.8% tax on net investment income for taxpayers who have adjusted gross income that exceeds $250,000 for married filing joint or $200,000 for single filers. Currently, included in that definition of net investment income are things like interest, dividends, royalties, rents, just to name a few. And this bill, though, is going to expand the income that's subject to this tax for taxpayers who have income greater than $500,000 for married filing joint or $400,000 for single filers. If you fall into that category, then if you have income that is from a trade or business that is not currently subject to self-employment income, and examples of that would be if you are a limited partner, so you receive a K-1 from a partnership in which you're not, you're just a limited partner, that income typically is not subject to self-employment, as well as if you are an S corporation stockholder and you receive a K-1 with your S corporation ordinary income, that typically is not subject to self-employment income. Well, under this new proposal, that income would be subject to the extra 3.8% tax if your taxable income exceeds those thresholds. So that's something to be to consider that could be coming down the pike. Okay, for non-corporate taxpayers with business losses. So once again, the Tax Cuts and Jobs Act, that brought us the code section 461L, and Val had previously talked about it, which limits the amount of business losses that you can claim against non-business income. This was set to expire at the end of 2025, but Val mentioned that it did get extended to 2026 under the American Rescue Plan. Well, the Build Back Better bill, again, I probably just messed it up, makes this provision permanent. So taxpayers who are limited in losses can carry this forward into future years into this plan, but those losses will not suddenly become net operating losses. They're going to maintain their character as Section 461L losses and have this taint and be limited as they get carried forward. So that'll be a change for those taxpayers who have these types of losses. Okay. Then we have for the very high income earners, they will see a little bit of a tax increase. So if you are a taxpayer who has modified adjusted gross income that exceeds $10 million, then you could be subject to an additional tax equal to 5%, as well as if you have even more income than that, if you have modified adjusted gross income of more than $25 million, then you're going to have an extra 8%, 5 plus another 3% tax that you could be looking at. So these are numbers that you want to consider if you have anybody who is the very high net wealth individuals. They will be the ones who could potentially see a tax increase in terms of their marginal tax rate. There will be a new above the line deduction, actually two of them, though it'll be $250 for if you pay dues to a labor organization. That can be claimed as an above the line deduction under this bill. There's also another $250 above the line deduction that would be through 2024 for the cost of employee uniforms. Now, uniforms have to be clothing that has to be worn by the taxpayer while performing services as an employee, and it's not suitable for everyday wear. So that's, when I think of that, I think of something like scrubs, as an example. All right, so a revenue generator for this bill to offset some of these expanded deductions that we're talking about today for taxpayers was bringing back the corporate alternative minimum tax and implementing a 15% minimum tax on corporations with adjusted financial statement income of more than $1 billion. This particular provision was really to go after the big corporations, probably in most cases publicly traded corporations that, you know, show this great book income when you're looking at their financial statements. But, you know, when it comes to actually looking at their tax return, they probably have very little tax that you hear about. So it's really going after them because they're saying your book income, your financial statement income, this tax would be 15% minimum on that. So this was generate some revenue. Okay, so next we're going to talk about Section 1202 stock. So Section 1202 stock, this can be extremely powerful because when you go to sell this type of stock, when you invest in it and then you sell it, you can exclude 50%, 75, or even up to 100% of the gain associated with the stock. And the percentage depends on the year that you acquired it, because the years changed, the percentage exclusion changed with the years. But let's do a quick recap of what Section 1202 is. So 1202 stock is stock that was issued after August 10th, 1993 by a C corporation that had gross assets that did not exceed $50 million. And the taxpayer had to acquire the stock at its original issue, although it could have been something like a tax-free transaction, like maybe they inherited it or they were gifted it or they got it out of a partnership distribution. But essentially they originally had to have it from the original issue. Corporations have to be, these corporations that they're investing in, they have to be active businesses. So they have to have 80% or more of their assets used in the trader business. And it can't be a personal service activity like health, law, engineering, and accounting. But I have seen more and more people investing in 1202 stock and getting involved with that because of this great gain exclusion. Unfortunately, though, the Build Back Better bill is going after that's the stock that qualifies for that 75% and 100% exclusion. They want to limit that. And unfortunately, even more so is that this particular part of the bill is one of the only pieces that is going to be retroactive to September 23rd, 2021, so September 23rd this year. Because that was when this when this particular part of the proposal was initially brought up. And so if you have sold it between September 23rd and now, you could be stuck with whatever this bill says. So they did make that one provision retroactive. All right, if you're a defense attorney who upfronts the costs for the cases, then you'll be able to now deduct those costs up front right away as they're paid. You don't have to wait until the case is settled, which that's a change from our current system. So if you're a defense attorney, talk to your accountant about that. Another major agenda for the bill was to fight climate change by expanding and extending energy efficient credits for both companies and taxpayers. So this includes things such as increasing the percentage of eligible costs that could be claimed as a credit for qualified energy efficient improvements, and also increasing some of the previous max limitations on claiming these credits. So for example, windows, they increased that to $600 per year. These still aren't really big numbers, but they could still be motivating some taxpayers to do improvements sooner rather than later. The next level of credits, unlike windows and doors, are typically bigger bangs for your bucks. And those include, installing solar electric property, solar heating, fuel cell property, and more. I don't currently see a lot of people taking advantage of these types of credits, but I do think that we'll start seeing them more and more. And, they're clearly trying to push this agenda by extending these credits for another 10 years in this current bill. Plug-in electric drive motor vehicle credits. So this is one that's really been gaining more and more traction. I've definitely seen quite a few people try to take advantage of this. Currently, a taxpayer, as the current law stands, a taxpayer can get up to $7,500 in credits for purchasing a qualified electric plug-in vehicle. I know different vehicles and different models qualify for different amounts. In order to take advantage of the full credit, though, the taxpayer has to have tax liability equal or greater to the actual credit itself, because this credit is currently not refundable. There are also currently limits on how many qualified vehicles each manufacturer can sell before they hit the maximum. So I believe Tesla and General Motors has already hit their maximum limit on that. So vehicles purchased under them currently no longer qualify for this credit. However, under the Build Back Better bill, this credit is going to become a refundable credit. So you do not need to worry about making sure you have enough tax to cover it and get to take advantage of it. So it's going to become refundable. And it's also the limitation on the number of vehicles sold by manufacturer is no longer going to apply. So that, you know, if you're interested in buying a car from Tesla or General Motors, maybe this could be your time. It'll also raise the maximum credit from $7,500 to $12,500. Again, that credit amount is going to be different per manufacturer, per vehicle. I know that some of the higher amounts is going to require that the manufacturer is actually manufacturing in the United States. They're going to provide some incentives to do work in the United States. So it goes vehicle by vehicle. There will also be some income limitations on who can claim this credit, but they're pretty generous. It's $500,000 for married filing joint and $250,000 for single filers. Okay, so real quick, I have just a few more things that we're going to talk about. So for the tax year starting in 2023, the foreign tax credit carry forward is going to be limited. Currently, it can be carried forward for 10 years. That's going to become 5 years under this bill. Also, it's going to eliminate the carry back of any foreign tax credits. So if you have significant foreign tax credits, you might want to start talking to your accountant about planning for them to figure out how you can get your biggest bang for your buck for them before they get lost. And then affordable health care, that was another major component of this bill. Val had previously mentioned how the American Rescue Plan allowed for households above the 400% of federal poverty level to still claim health insurance premium tax credits when obtaining health insurance through the marketplace. Well, this bill is going to further extend that through 2025. It also would exclude from that income eligibility calculation any one-time lump sum payments received from Social Security Administration that are catch-up payments attributable to prior years. It'll also allow taxpayers whose income falls below 100% of federal poverty level to still be able to claim the premium tax credit because those taxpayers were previously not allowed to claim the credit because they would have qualified for Medicaid. And it also will temporarily allow taxpayers who are provided affordable employer-sponsored healthcare to still go to the marketplace and claim the premium tax credit, even though their employer is offering them affordable health insurance. Essentially, you know, all these things are temporary and, you know, wanting to expand taxpayers' options and ways to obtain affordable healthcare insurance. But once again, this part is temporary. It'll also continue to require employers with 50 or more full-time equivalent employees to make their lowest cost health insurance option be no more than 8.5% of the employee's income, which is down from the original Affordable Care Act's percentage of 9.61%. So that definitely puts a little bit more of a strain on the companies who employ large amounts of people for low wages. And lastly, we're going to talk about the retirement changes, because I think outside of the increase in the cap for state and local tax deductions and the potential extra net investment income tax on, you know, our S Corp and limited partners, I would say this is the other big change that's coming down the pike included in this bill. So there's a couple years, we're going to go in chronological order here. So effective starting in 2022, the bill eliminates the backdoor Roth conversion. So this is like a really big one. Currently, taxpayers who make too much money to contribute directly to a Roth IRA, they have this option to do what's called a backdoor Roth conversion. So what you essentially do is you first do a non-deductible contribution to a traditional IRA, and then you immediately roll that over. So before it even can earn $1, you immediately roll it over into a Roth IRA account. It essentially gets you to the same spot as if you had contributed directly to a Roth IRA, but it's just an extra step. It does get messy if you have other traditional IRAs already, because then you have to do a pro rata calculation. So it really works well when you don't have any other traditional IRAs. It's still doable, but it gets a little bit messier. Unfortunately, this entire option to do backdoor Roth contributions would be completely closed for everyone effective in 2022, regardless of income. Effective in 2029. So these provisions are for the mega retirement accounts. So the accounts that are really, really large. So the people who would fall under this are people who had retirement account balances, when you aggregate them all together, over $10 million, as well as their taxable income is greater than $400,000 or $450,000 for married filing joint. So you have to have both of those criterias, in which then it would start to trigger the following results. So it would eliminate any further contributions to an individual retirement account. So you could no longer contribute to it. It would also accelerate distribution. So it would actually create a required minimum distributions if you fall into that category, which would be equal to 50% of the balance exceeding $10 million. So if you have a $20 million aggregate retirement account balance, then this could really, really hurt, because 50% of over $10 million, that could really hurt. It also could, for retirement account balances that exceed $20 million and involve some Roth accounts, then the excess would be required. You'd actually be required to distribute out the lesser of the amount to bring your total balances to 20 million, or the total balances of the Roth account, whichever is lesser. So those are some pretty big penalties. They're definitely going after the mega retirement accounts here. So, if you fall into that category, if you know someone who falls in that category, this is definitely some time to do some planning to try to strategize on how to avoid getting a really, really big tax bill, potentially, in 2029. So we have a little bit of time to plan for that, but not a lot. And then also we have in 2032, so that's a little bit farther away, but for those who have taxable income greater than 400,000 or 450,000 for married filing joint, it would eliminate the Roth conversion. So the Roth conversion is, something we talk a lot about in planning, something we like to use a lot. Optimal times being, when you have a lot of deductions, or you're in a lower tax bracket, or maybe, the market is in a slump, are times where we really like to take advantage and convert some after-tax dollars to Roths and take advantage. That could be going away in 2032. All right, so that concludes my section of the presentation. I'm going to hand it back to Michael Kelly, who is going to wrap it up.
So we're going to talk about the Consolidated Appropriations Act and maybe some other year-end planning. The Consolidated Appropriations Act was passed in December of 2020. So that was one of the first items passed after the CARES Act. So let's go over that. Okay, first thing we'll talk about are medical expenses. This becomes one of those frustrating things for CPAs every year, because it's, we all should know that medical expenses are deductible up to 7.5% of AGI. So for example, if you make $100,000 and you make $100,000, 7.5% of that would be $7,500. So you need medical expenses above and beyond $7,500 in that situation to get any type of deduction. Sorry, I'm getting a few messages here. It's distracting me. So what that 7.5% threshold seems to change every year. It's either going to be 7.5%, 10%. It goes back and forth every year. And eventually, let me rephrase that. It goes back and forth every year, but then eventually seems to go back to 7.5%. But there's always talk about raising that to 10%. So the one good thing that came out of this bill is they have made that 7.5% threshold permanent after 2020. The CARES Act passed in March 2020 made some changes to your charitable contribution rules for 2020. The two big ones were, if you took the standard deduction, you were going to be allowed to take above the line deduction of $300 up to $300 for charitable contributions. So in addition to the standard deduction, you could take an above the line deduction for charitable contributions. Usually you can only take charitable contribution deductions if you itemize your deductions. So that was the first one. The second thing was in 2020, you were allowed to deduct up to 100% of your cash contributions. I'm sorry, up to 100% of your AGI for cash contributions. Typically, you're limited to 60% of your AGI. So that really opened things up for those who were very charitable in nature. So the Appropriations Act essentially extended both of these rules, the above the line deduction for charity, the 100% AGI rule till 2021. So one last time there. The one big difference with the above the line deduction, it really, in the past, in 2020, the $300 deduction was a deduction in arriving at AGI. In 2021, is a deduction in arriving at taxable income. If you are a teacher or you know someone who is a teacher, they get a deduction above the line for $250. That deduction isn't much, $250. It's very easy, and it's pretty much for any classroom supplies that the teacher spends money on. So it's very easy to get to $250 above the line. There's been something added in there related to any type of supplies or other types of purchases that a teacher uses to help with the prevention of COVID-19. So if they buy some disinfectant for the classroom, that also counts to this $250 deduction. It's pretty much ado about nothing, because probably most teachers, already spend more than $250 for their classroom supplies. You may be familiar with educational credits that you get for the cost of higher level tuition. There was always something out there called the tuition and fees deduction. You could take this deduction instead of going after the educational credits. I never saw a situation where the tuition and fees deduction was more beneficial than the actual credit. But this deduction has been eliminated after December 31st, 2020, so no need to even worry about that analysis moving forward. I just mentioned the credits for education. There's two of them, the American Opportunity Credit and Lifetime Learning Credit. The American Opportunity Credit is typically the more generous of the two credits. It's used for your first 4 years of education. But if you're going back, maybe you change your career, want to go do something else, you can still maybe qualify for the Lifetime Learning Credit, which isn't as generous as American Opportunity Credit, but it's still available. In the past, there's phase out levels of both these. You make have too much adjusted gross income, then that will impact your eligibility for these credits. The American Opportunity Credit always had a higher threshold before it started getting phased out. Then the Lifetime Learning Credit, those phase out levels have now been combined to be the same for each credit. Some of you may be familiar with your PMI. When you don't put 20% down on a mortgage, you may be subject to PMI. And every year, this is like the medical expense one that we're kind of bouncing back and forth every year. Will they allow you to deduct PMI and as qualified mortgage interest? And this year it has been extended one more time for 2021. We will meet again in 2022 to see if you can still deduct that. Even if you can deduct that, there are pretty low income thresholds that allow you to take that deduction. 163J interest limitation, one of the worst code sections ever invented to man or woman. The CARES Act brought us this, and what in its most simplest form, what it has said is if you are a big boy taxpayer, I think it's about $26 million of average gross receipts, 26 million, then you could be subject to 163J. What that means is your interest that you can deduct is going to be limited to 50% of your adjusted taxable income. So if you have low taxable income, your interest deduction may be limited. And I'm sorry, I said the CARES Act brought us this. The CARES Act did not bring us. The TCJA brought us this 163J. The CARES Act modified it. And what the CARES Act did was it reduced the TCJAs originally had the threshold at 30% of AGI. CARES Act actually increased it to 50% of adjusted taxable income, not AGI, adjusted taxable income. That limitation, that 50% limitation reverts back to 30% in 2021. One thing I want to mention here is if you are the syndicate rules. What a syndicate is if you have more, I believe it's more than 35% of losses if you have losses getting allocated to more than 35% of members of an entity, you may be a syndicate. And what that means is you could be subject to 163JA without question, it doesn't matter whether your gross receipts are 26 million or more, you could still be subject to it. So think of your rental partnerships that are kicking off losses. You may be subject to 163J. You could have your interest limited if your losses are getting passed through to members who are not participating in the business. Qualified opportunity zones. This also came out of the TCJA. What the qualified opportunity zone does is it allows you to defer capital gains if you decide to invest capital gains inside a qualified opportunity fund. That's a qualified opportunity fund is some sort of fund that is dedicated to like improving impoverished area. So how this works is if I have a capital gain, let's just say in 2021, if I invest it inside a qualified opportunity fund within 180 days after realizing the capital gain, then I can defer tax on this capital gain through 2026. The first benefit of this is by holding the capital gain in there for 5 years, I can essentially cut off 10% of the capital gain when it's time to get recognized in 2026. So 10% of the capital gain will never ever be taxed if I keep it in there to 2026. On the slide, I also mentioned a 7-year period, which could also cut off an additional 5 years. That 7-year period, we're out of time there. 2026 is less than 7 years away, so we can't qualify for that. 2021 is the last time you can qualify for this. So I had a couple clients that thought about doing it and they just did not pull the trigger. But if you have substantial capital gains, if you're comfortable in this investment, right? Any type of investment you can lose money in. So you got to think about that side too. But if you're comfortable with the investment itself, and you're okay with not really touching this money for 5 years, that's one way to cut off 10%. Now, say you take $100,000. Now you have to have capital gains. You have to have capital gains. You got to get those capital gains in within 180 days of realizing them. But say you had $100,000 of capital gains, you invested that in a qualified opportunity zone. If your interest in this fund grew to $150,000, then $50,000, that $50,000 of growth would be forever excluded from income. So that's the more attractive thing, not necessarily losing or cutting off 10% of tax. It's that growth above your investment that's really attractive. For those that are interested in the estate and gift world, the annual gift exclusion, the lifetime exemptions are increasing. Let's just do a quick recap of what they are. Before we do the recap, the gift exclusion is increasing from $15,000 to $16,000 from 2021 to 2022. The lifetime exemption is going up from 11.7 to a little bit above 12 million from 2021 to 2022. So what is the gift exclusion? If I give away money in 2021 of more than $15,000, it doesn't have to be money, it could be anything. If I give away anything worth more than $15,000, then the gift, then I'm going to be required to file a gift tax return. That doesn't mean I have to pay a tax, but I have to file a gift tax return. If I'm married, I probably can get away with giving away $30,000, unless that $30,000 is coming from one spouse's account, then I would have to file a gift tax return in that case. The lifetime exemption, you want to think about that as your cumulative bucket of lifetime transfers, whether it's through gift or whether, at death I leave things to other folks. If my cumulative transfers go above the $11 million, 11.7, and I happen to pass away in 2021, then I will be subject to an estate tax of 40%. If I'm married, then I get twice that amount. These amounts are going to pretty much decrease by about half, I think, in 2026. So these amounts are definitely huge amounts that are going to most likely go down in the future. The changing state tax landscape. COVID came, we all started working from home. Some of us went back to work, some of us kept on working from home. I work from home in Pennsylvania most of the time, and Delaware, my employer is in Delaware. Delaware is a convenience of employer state, and there's a few states out there that are convenience of employer instead of convenience of employee. What that means is, even though I don't come into the office that much, Delaware doesn't care. Delaware says, I'm working at home for my convenience. It's not like my employer is asking me to go out and get more business in Pennsylvania or has ulterior motives for me working in Pennsylvania. And in that case, so Delaware says, since we have convenience of employer rules, you're for the convenience of employer rules, and you're doing it for the convenience of yourself, the employee, we still want to tax your wages, even though you don't really step foot in Delaware that much nowadays. So, if you're working from home, you got to be aware of these rules. Every state has different rules that really, state taxation can get really complicated. Just be aware those type of things could be out there if you're working from home. For your business clients out there, you also have to be aware of this issue. If you have a bunch of employees working from home, and maybe you're the employer operating in Delaware and you have 20 employees working from home in PA. are you doing business in Pennsylvania because you have all these employees working from home in Pennsylvania? Every state has different rules here, and some of the guidance isn't that great, but be aware that is a potential issue for you that you should be aware of. If you're interested in inflation adjusted numbers, feel free to Google Revenue Proc 2021-45. It shows like how much the standard deduction increased. Ignore that line about the personal exemption, that's still zero. But it shows how much your marginal tax brackets have increased, at least from an income perspective, and a bunch of other things. So if you're interested in that type of thing, a Google on Rev Proc 2021-45 will hopefully answer your questions. If you're a Delaware employer, you may have received a Delaware relief grant. If you did receive a Delaware relief grant, this is a quick reminder that the due date to submit your documentation to Delaware is at the end of this month. If you don't submit the documentation, this grant will become a loan and you will have to pay it back. So the type of documentation you need are your 2019, 2020 tax returns that show a drop in revenue, and you will need receipts, invoices, maybe check stubs to prove that you used the grant on the eligible expenses. Okay, that concludes our presentation. There were a couple questions that came through that we answered already. So 1 second, so we pull them up. All right, someone asked, is eligibility for the ERC limited if you received a PPP loan? And it could be limited if you cannot use the same wages for the ERC and the PPP. So that's the one most important part, is we want to make sure we do an analysis of determining whether the wages are not counted in both spots. And we try to maximize, both of these items to the best of our ability. Second question was, I understand that in general, investment income is included in gross receipts for the ERC. Regarding investments in your publicly traded partnerships, do you think that either distributions, return of capital, or share of pass-through income not constructively received from these partnerships should be included in gross receipts? So I think your gross receipts for the employee retention credit essentially is going to capture the items that hit your tax return. So the person that's asking this question is asking about your pass-through income, but your pass-through income that you don't necessarily get in your pocket today. So pass-through income, even if you don't get it in your pocket, like from your publicly traded partnerships, is still reported on your tax return. So anything reported on your tax return, I would say, is including your gross receipts. As far as the distributions, your distributions are typically not going to be recorded on your tax return unless it is a distribution in excess of basis, which may result in a capital gain. So that could be one item that I would consider in my gross receipts test. 2 more minutes. Does anyone else want to throw any questions at us? No, we got one. Opportunity zones. If capital gain rates increase before the end of the deferred period, do you use the rate in the year the original gain was realized or the end of the period? That's a good question, Pete. I don't know 1,000%, but I would assume that is the capital gain rate in place in 2026. I think that's a pretty good assumption. All right, well, thank you. Thanks again for having us. It's always a pleasure being able to talk a little tax with you guys. Signing off.